If you're self-employed, banks will usually need more from you before they'll lend compared to a PAYG employee. But that's exactly what this episode is about, understanding what banks are looking for so you can present your income in the best possible way. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Hello, and welcome back to another episode of First Home Unlocked. How are you today, Chris?
Doing well, Jack. It's only the end of the first week after the budget, and lots has obviously changed. It's really good news for first home buyers. It's kind of highlights what we've been saying all the way back to last year on this podcast around the importance about what they buy. But, from a competition point of view, it's actually really good for them and gives them a much higher chance of actually securing something, which is what we've seen this week, right, Jack? I think there's been a number of clients that purchased.
Yeah, definitely. We have seen that. A lot of clients purchasing, also reporting to me that at open homes, auctions, etc., there's a lot less people there. So it is really good news for first home buyers. But like you said, Chris, it's all about that asset quality and actually buying a good property. Sometimes when there's more options available to you, you just got to slow down and take that time to do that work up front to make sure that you're buying that good quality asset that's going to serve you over the longer time as well and potentially grow in value for you. So look, in the past episodes, we've spoken about PAYG income, including overtime, bonuses, probation, and parental leave, then all things casual and contract income. So today we're moving into how banks assess self-employed income and how that affects your borrowing capacity. Now, if you're self-employed, banks will usually need more from you before they'll lend compared to a PAYG employee. But that's exactly what this episode is about, understanding what banks are looking for so you can present your income in the best possible way. So in today's episode, we're going to cover how banks assess self-employed income, why one-year financials could significantly increase your borrowing capacity, what your options are if your ABN is less than 2 years old, how the director wages pathway could change what you're able to borrow, and your tax returns and why speaking to a broker before you lodge them is so important. Now, Chris, having worked with self-employed buyers for as long as you have, what's the key message you'd want them to take away from today's episode?
Look, your situation is harder, right? It's more complex. And what I say for that is that you do need a broker that understands how to read financials, how to understand how banks will look at your sort of balance sheet. You still need an experienced broker. I mean, as you sort of get, and it depends on how complex your business is, and the more complex it is, the more experience your broker needs to have. It's not something that, and there's a lot of advantages sometimes, but there's also a lot of disadvantages with self-employed. It actually is, which we're going to talk about today, but it just really highlights where a great broker can add a lot of value. If you've got like a PAYG income and you're borrowing well within your limits, and you can probably walk into any bank and you're pretty much going to get the same product, you're going to get the same rate. There's little differentiation. As soon as you step into the self-employed world, every bank does look at it a bit different. And this is where we really careful on who we lodge your loan through and how we position you to the bank. And so, there's a lot of value in great brokers when you're self-employed, not just with getting residential finance, but it might shift into some business finance. It might shift into sort of commercial. There's a lot. And it sometimes also goes through different channels as well, because you've already got an existing relationship with the bank, and you have to then also work with that team together with their residential team. So there's a lot more going on when you are self-employed.
Yeah, and I think a key message from this episode, Chris, that we're going to go through and jump into in a minute is that lender selection matters the most for self-employed. Now, there's different ways that they can look at your income. There's different ways that we can present you to the bank. So first of all, let's start with the standard approach banks take with self-employed income. So most lenders will look at 2 years of tax returns and business financials, and the number they're focused on is your net profit. Now, they want 2 years because 1 year doesn't prove your income is sustainable. They want to see consistency before they'll be comfortable lending to you. So lenders look at your net profit across both years and use the average of that. Now, if 1 year was quieter than the other, the lower year reduces the average and also reduces what you can borrow. Now, something I see come up a lot with self-employed first home buyers is the trade-off between tax minimization and maximizing your net profit figure. So you're working, for example, you're working with your accountant to claim tax deductions and reduce your net profit, which then reduces your tax bill. Now that makes complete sense from a tax perspective, but the same net profit is exactly what the bank uses to work out how much they'll lend to you. So the more you reduce it for tax, the less you can borrow. And if buying is on your radar, it's really important to be having that conversation with your accountant and broker early on. Because if you've spent the last 2 years minimizing your net profit to reduce your tax bill, the amount you can borrow from the bank will be reduced as well. Now, the earlier you start thinking about finding the right balance between your tax and home ownership goals, the stronger position you'll be in when it comes time to buy your first home. Now, Chris, that tension between tax minimization and borrowing capacity is something that you would have seen played out with a lot of self-employed buyers over the years. How do you help them find the right balance between the two?
Look, it's actually probably got a little bit easier, I'd say, than, when you think about when I started, absolutely, banks would not look at what you were getting paid as a salary. They'd look at your 2 years financials. Some would use an average or the lower. And, I think self-employed lending in 2026 is a little bit more relaxed, right? A lot of them will look at the last 12 months and they'll also look at just sometimes your salary. And so, yeah, this is one you want to get on the front foot because in today's market, there's things that you can do to still borrow. And, even if your net profit isn't there, by paying yourself a salary, et cetera. And it is a bit of an age-old problem. I do feel like you've got to be careful when you are going to your accountant and absolutely they're trying to make you minimize tax. But on the other side, they go and put you to their lending or their broker and, they're not really aligned to, looking at the alternative strategy of potentially paying a bit more tax and potentially having a higher income and then giving you more options personally to borrow. And so, sometimes you're not paying more tax, forever. You're just paying more tax this financial year versus next financial year. So you just got to be pretty smart with it. And we often have to play a little bit of a game here with self-employed just to help clients really figure out what's the optimal way to, because sometimes if you lodge your next year's tax returns, it reduces how much you can borrow. And so there's always a bit of a dance with our self-employed clients on how to, best structurally set up their lending.
Yeah, I think you're right there, Chris. It's a balance. It's a bit of a game to work out that best approach to put you in the best position to buy your first home as well. Now, like you mentioned, there are a couple of policies that have come to light over the last few years that have made self-employed income assessment a lot easier. So it's called 1 Year Financials, and it's where a lender will assess your self-employed income using your most recent year's tax return. And for buyers who have had a strong recent year after a quieter one, this can make a really significant difference. Under the standard 2-year approach, that quieter year pulls down your average and reduces what you can borrow. But with the right lender and the right policy, we can use just your most recent year, exclude that lower year entirely, and that can open up a lot more options for your property purchase. Now, to show you the impact of using this policy, I had a first home buyer I recently worked with. Now, he was a sole trader builder, 4 years self-employed. 2 years ago, his net profit was $90,000. Last financial year, it increased to $130,000. Now, if we use the standard 2-year approach that we just spoke about, the bank would have used his average income over the 2 years, which was $110,000, putting his borrowing capacity at around $589,000. Now, because we could use 1 year financials, the bank used $130,000 towards the assessment, and his borrowing capacity jumped to around $740,000. So he could borrow around $150,000 more just by having the right policy applied to his situation. Now, to use this policy, there are a few standard conditions. Most lenders require your ABN to have been registered for at least 2 years, though some lenders will accept less, which we'll talk about soon. You're also typically borrowing at 80% LVR or below, which means you generally need to at least 20% deposit or a support option like the 5% deposit scheme. Now, in some cases, the lender will shade your income, which basically means instead of using 100% of your most recent year's net profit, they might use 90%, for example. Now, this is a small discount to account for the fact that there's only 1 year of evidence rather than 2. Now, Chris, for self-employed buyer who's ready to take on a home loan, what are the key things you'd want them to have in place to set themselves up for success and protect themselves once they're in the market?
Get that ABN ASAP. That'd be the first thing because, they do sort of use that as a bit of a line of when you started your business and you might not have actually started it by then, but you've got your ABN and get your company, even if you're thinking about transitioning from a job to starting the business, like get that structure set up early. And, get that sort of runs on the board, because I do think a lot of lenders, just have that restriction on there. And if you sort of delay it to day one in business, it sort of can really hold you back. Secondly, try to think in financial years. I think, there's, like you'll think, well, I've got this 4 or 5 months till the end of the financial year. Well, I've got to try to like make the next financial year. And so you can be quite strategic in terms of with business, in terms of when you sort of book income and, expenses, etc. And sometimes you just got to be like, okay, well, if my goal is really to buy a home and I really need my income to be quite high over that financial year, is there any tweaks I can make to my business model to really make sure this is a really good financial year? And, that sometimes goes against, sometimes business decisions. You might say, well, I'm not going to go and spend that money on marketing till July or whatever it might be. And so you got to be really careful of just making sure you're strategic around how you run your business financials, because it's a total different game to employed. You can say, well, I've got this amount of revenue and my revenue's going up, but if the bank can't see the profits going up because you're investing a lot, then that might really hurt you. And so you might just have to be a bit more strategic about when you actually invest in the business.
Yeah, and I think to add on to that as well, Chris, then there's that layer of protection as well. So having a cash buffer or emergency fund in place before you commit is really important as well, because as a self-employed buyer, a good target is at least 6 months of essential expenses. Now, that means your repayments, your groceries, your bills, the things that you need to cover no matter what. 3 to 6 months is a common benchmark, but with fluctuating income, 6 months might help you feel more confident. And like any first home buyer, you also want to make sure there's genuine flexibility in your budget. Rate rises are a reality over the life of the loan. So before you commit, it's worth asking yourself whether you could comfortably handle your repayments if rates moved up. If the answer isn't a confident yes, it's worth thinking about whether you're borrowing at the right level for your situation. And just because a lender will approve you for a certain amount doesn't mean you have to borrow all of it. You do want to be getting the best quality asset you can comfortably afford and hold for at least the next 5 to 10 years. Building in that buffer and that flexibility is what allows you to stay in the market comfortably over the long term, not just get into it. Now, Chris, we touched on this before, but paying yourself a wage. So that's the next pathway, and it's called director wages. And this one is specifically for buyers who own their own company and are paying themselves that regular wage. Now, the wage you're paying yourself shows up on your ATO income statement, so it can be verified with pay slips the same way any other employment income would be. So the bank assesses your verified wage rather than needing to assess your full business financials. Now, this can really help you because, as we talked about earlier, company net profit can fluctuate or can be significantly reduced by tax minimisation strategies. Your wage, on the other hand, gives the bank something clear and consistent to assess, which is why it can put you in a much stronger position than your net profit does. Now, to use this pathway, there are a few conditions to be aware of. Firstly, it's specifically for company directors. So if you're a sole trader, this pathway won't apply to you. You need to also have been paying yourself a consistent wage for at least 6 months, and that amount needs to stay the same. If it's been varying month to month, lenders will typically use the lower amount paid over that period. The business also needs to be profitable, which is usually evidenced through an accountant letter or your most recent business tax return, depending on the lender you're using. And importantly, your wage needs to stand on its own. Now, you can't use this pathway and then also rely on additional business income or distributions on top of it to support your application. And it's also worth knowing that not every lender offers this policy and the conditions do vary. So your business structure can affect whether you're eligible. So as always, it's worth having a conversation with us to work out which lenders are going to work best for your specific situation. Is there anything you want to add here, Chris, about director wages?
Look, if you are self-employed and, you're broker or you haven't even thought about this and you are early days in business, like this is absolutely a way that, potentially you can borrow, even though you might feel that, you're just not at that level from a financials point of view. And, it's good practice to get in anyway, is to actually be paying yourself a wage, and getting your bank statement every month and start to be living like you are employed. I think that's a really good habit for business owners. I wish I did it earlier in business, to be honest. I think it's it's a really good mindset shift. And so, yeah, consider that not just from a personal point of view, but also I do think it helps with lending in those first few years. And you can always up your salary as well if you feel like it's just set up low just for the start. And so, yeah, be really careful that you are considering this option, because I have seen clients that have come, waited for the financial year and, and then they've come to us and said, well, yeah, you could have done wages. Like this policy has been around for a little bit. And you could have potentially bought, 3-6 months earlier. And so, yeah, definitely be considering this option.
Yeah, that's really good points to consider there, Chris. Now, let's move on and talk about what happens if your ABN is less than 2 years old. Now, a lot of self employed buyers assume that if their ABN is relatively new, no lender will touch them. And while it does give you fewer lender options, it doesn't mean you can't get a loan. Now, most lenders do require 2 years of ABN registration, but there are lenders who will work with 18 months and some who will consider 12 months or less. Now, for those lenders with more flexibility, what they're really looking at is your industry experience before the ABN was registered. Now, if you can demonstrate 2 or more years working in the same industry before going out on your own, some lenders will take that into account even with a shorter ABN history. So the options do exist, they're just with a more specific group of lenders, and it's very much a case by case conversation. Now, Chris, some of the lenders who offer more flexibility with shorter ABN history are mid-tier or non-bank lenders rather than the major banks. Is there anything a first home buyer should understand about using one of these lenders before they go down that path?
Yeah, look, we aren't huge on low doc loans. Like we haven't done it's not, we haven't structured our business this way. It is a lot higher risk for the bank. It makes sense, right? So they want to price that risk. So they want to charge you a sort of higher rate. I think you've got to be careful because what you want to do is get off that rate ASAP. And so you really, if you're going to use a low doc loan, you want to go low doc just for the gap and then straight to a full doc application as soon as your financials hit. And so we have seen there's a strategy in terms of getting access to lending early if you're really confident. Where I would really be hesitant, however, though, is if you're only doing low doc because you know that the financials are all over the place and you're also a bit worried how this is going to present to the bank and you're just going to tie yourself into a higher rate of lending. And banks will obviously put a bit more of a risk weighting on it as well. They want bigger deposits and they want to really protect themselves in these situations. And so you can go wrong. It can go wrong where you end up paying a lot of money for debt. And if you don't buy good assets, you really can just shoot yourself in the foot. And so be really careful with some brokers, pushing you down this low doc loan, just go, and aren't really explaining the risks. And that's also the case with any non-bank lending. There's a lot of things you just need to understand when you go down this route is that, their access to funding is nowhere near as broad as, say, the bigger banks. And you just got to be careful you don't get stuck and become a mortgage prisoner at the wrong bank.
That's right. It's all about the balance again there, Chris, and working out, well, is this going to help me in the long term or is it just a way to get in and I haven't really planned that next step? So just really be careful on that. Like Chris said, I want to double down on that as well. Now, next I want to touch on is business debts and Addbacks. So if your business has debts, things like equipment finance or business overdraft, it's worth knowing that many lenders will actually exclude those business debts from your personal borrowing assessment entirely, because they see the business as covering those commitments from its own cash flow. Now, a smaller number of lenders will count them against your personal borrowing capacity. Now, that's actually a really positive thing for a lot of self-employed buyers because it means those business commitments won't drag down what you can borrow personally. It's one of the reasons lender selection really matters for self-employed buyers. Now, some lenders will also use an add back, which is when a lender takes a business expense from your tax return and then adds it back to your net profit, which increases your assessed income and therefore your borrowing capacity. Now, the most common ones are depreciation on business assets. So it shows up as an expense on your tax return, but it's not actually cash leaving your account. So most lenders will add some or all of it back, but the percentage does vary. Some lenders allow a full amount add back, others cap it at 20% or 50%, for example. So lender selection matters here too. The next is extra super contributions above the compulsory rate, because those are a choice you've made rather than a fixed business cost. And the last one is a one-off expenses that won't repeat. Now, for example, like a specific legal cost or a project that's now finished, these usually need a letter from your accountant confirming they're not ongoing. The key thing here is that Addbacks can increase what the bank assesses your income as without anything about your actual financial position changing. Now, we've also seen business owners use the government's instant asset write-off to depreciate equipment or vehicles in a full single year. Now, it's a great tax strategy, but it significantly reduces your net profit on your tax return. The good news is a number of lenders, including some of the major banks, will allow you to add that write-off back as a one-off expense, which can make a real difference to your borrowing capacity. But not all lenders treat it the same way, which is why it's important to chat with us so we can put you with the best lender for your situation. Now, Chris, there's clearly a lot of moving parts when it comes to self-employed income. How important is it the way a broker structures and presents an application when it comes to getting the best outcome for a self-employed buyer?
I mean, this is why I love having, Ben in the business, CPA background, I mean, I studied accounting and sort of tax, and so I sort of know that stuff as well. But like, you just sort of really want to have a broker that sort of gets the numbers right. And I think internally, when we look at our sort of strategy team broadly, we focus on people from an accounting or financial planning background because, reading financials can be difficult, and having conversations with accountants to, restructure the accounts that are going to make better for the assessor. And it's not just, that's kind of something that people maybe don't really understand. Like when we lodge an application, it's not just like a yes or a no. Often it sits in this maybe camp, and we have to sort of educate the assessor on why we think it should get approved. And you would be surprised at how many times we have to basically educate the assessor on how their own policy works around this, and that sometimes they do their calculations wrong, and we have to educate them on why it's wrong, and they haven't added that back, and they should have added this back. And so, great mortgage strategists know how to look at your financials, how a bank would look at them and present them in the right way. And it's not sort of foreign for us to even to say to the accountant, can you restructure the accounts to present in this way so the bank can better understand them and show the things that they can add back much easier. And we're better off doing that before you lodge an application. I just want to put that out there, because if you do it after you've lodged the application, the assessor's often sometimes on the back foot, and you want to basically present your application the best way possible when the bank assessor looks at it and they go, yeah, they've thought about everything here. Everything's so nice and neat. It's really clever. It's well presented. There's good notes. And this is what we often have to do as self-employed, because it is a high risk lender. It gets assessed by a more senior credit person in the bank, but unfortunately bank credit staff don't usually last that long. And so they usually move on. And so a lot of the senior people still aren't that senior or new to the bank because they've switched from bank to bank. And so, yeah, that would be my tips here, is just get a good broker that really understands this stuff, particularly if you've got a complex business and you've got lots of different entities. And some accountants can get very creative on how all those entities set up. And so we've got to be able to, the broker's got to be able to explain to the bank sometimes how those entities work as well.
Yeah, and I think, like you said, Chris, there's a real opportunity to get the balance right before you lodge your tax return. Now, the way you do that is by connecting your broker and your accountant. When the three of you are working together, your broker can give your accountant a clear picture of the income level you need to hit your borrowing target. Your accountant can then structure your tax return with that in mind. And you're not choosing between a good tax position and a good lending position. You're finding the right balance between both. Now, I've seen it go both ways. Buyers who come to us early, we connected with their accountant, we found that balance, and they were able to borrow what they needed. On the other hand, we've seen buyers who have come to us after the return was already lodged. Their net profit was lower to save more on tax, but then their borrowing options were limited. So the earlier you start that conversation, the more doors that stay open for you. Now, Chris, before I wrap up, any final thoughts for self-employed buyers listening today?
No, it's one of the things I'd say finally is, I get when you're self-employed, your business is everything, and investing in your business can have a really good return on equity. So, often buying property or investing other assets doesn't feel as good as the return on buying, a home, for example. But just remember, you can potentially do both. You can potentially still give yourself all the ability to grow your business and invest in your business, but off the side, particularly if you structure your lender the right way, and particularly if it's your first property, it does allow you to potentially even get business lending down the line. You could borrow against that property to then reinvest into the business. Like, there's all these doors that open up once you become a property owner. And also you can get an asset growing for yourself tax-free. And so, yeah, maybe sometimes if they're self-employed, they're so focused on just getting the business going, they sometimes neglect personally what they can do. And then they potentially just don't take advantage of that as well, right? And there's usually some good sort of benefits being a property owner and a business owner. And so that'd be my final point. And it's not forever as well. Sometimes, if you make some equity in properties, you can always then use that equity to reinvest back in the business. And so whatever you do invest personally can all sometimes follow its way back to the business.
Yeah, so as you can see, there's a lot of pathways to consider when it comes to self-employed income. Now, as always, it's really a case by case. The right approach for you is dependent on your business structure, how you're drawing income, your deposit, and where you're at in your journey as well. Now, what I will say is that having the right team around you makes a real difference here. We can workshop your situation with the lenders, look at all the options available to you, and find the most strategic way to present your self-employed income to support your home ownership goals now and into the future. The buyers who get the best outcomes are the ones that start that conversation early. So if you're self-employed and buying is on your radar, don't wait. Come and have a chat and we can put a plan together that balances your property goals and your financial situation. You can book a chat with us using the link in the show notes. That's it for today. Thanks for listening and we'll talk to you all soon. Thanks, Chris.
Thank you, Jack.
Thank you so much for listening. We'd really appreciate if you could do us a huge favour. Share this episode with any first home buyers that you know so we can help more people like you feel clear, calm and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get to know you chat by using the link in the show notes or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.